Hello, traders everywhere. Thanks for joining me today. It's 3:30 Chicago time, 4:30 Eastern on Thursday, the 18th of July, 2019. Welcome to another public AMA session. The last one was held in January of this year. They occur about once every 6 months, and actually, we're discovering today that probably that's not often enough. I used to hold these about once a month, and then the questions just got repetitive. A couple of real quick housekeeping items. First, I want to make sure you can hear me loud and clear. Just say yes if you do. Okay,
Yes.
awesome. Thank you. Yoda's here with me. Yoda is just keeps me in check in terms of time. Couple of ground rules here. One, the risk disclaimer: derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. The opinions I'm sharing are my own and based on my experience. Also, we received over 100 questions that were pre-submitted. There were 3 mic requests. We have 60 minutes. Beyond 60 minutes, traders just cannot listen to anyone, even someone with my fantastic voice and that of Yoda's. That's just a lot of time that it would take to go through these questions because they each need about 3 to 5 minutes or something like that. So here's what we're doing. We took and removed we filtered out all of the questions submitted by Convergent Trading members. The reason I did that is because every Tuesday we have a trade talk in which I walk through the market, and also we open it up for questions. And so you can ask your question there. We know a lot of members have been around for a long time, and you're not going to be offended if we prioritize those people who are not members so we can address those because this happens rarely, whereas for you as a Convergent member, it's every week. The second is we prioritized the questions that were being from people who are asking for the first time. So many of you have been following since 2008, and we've interacted in some way. I recognize a lot of names. So we're prioritizing those people who are brand new for obvious reasons. I mean, we want to help them get going. And then the other thing is we normally prioritize mic questions, and we're not going to be taking mic questions because of the high volume. Again, it's 103 questions today that were submitted, and there's a high volume of questions, so we're not going to be taking questions over microphone. Generally, those are more fun for me because we get to talk back and forth, but also they take too long. Generally, people kind of get nervous and they take long to make their point. I often do that. Yoda can attest to that. So I'm going to prioritize your questions. Those people who requested sent in a mic request. I'll prioritize your question and answer it first, and then we'll run through until time runs out. So I don't know how far we're going to go, but we're going to try to keep it to a couple minutes per question. So my question is going to be succinct. We're not going to take questions in the chat box. Normally we do, but we're not. Again, we're overloaded. And Yoda's going to do his best to kind of inform people as they come in. So let's get started. Again, this is a Convergent Trading public AMA. I'm FuturesTrader71. Hopefully you've heard of me. If not, I've been trading for about 19 years and ran a prop shop for a while and have come online around 2008. Actually, it came online much earlier than that when I switched from being a scalper to a structure trader, but I became active in contributing to the community since about 2008. Let's start with the questions. The first question, I notice sometimes an HVM, which is a high volume node. An HVN is an area of the chart where there's a lot of volume. It's like this black area here, this black area here. Those are high volume nodes. This is a volume profile. This is showing us how much volume traded at each price. So a high volume node versus a low volume node. This is a low volume node right here. It's a price or a series of prices where very little volume took place. I'm not going to get into the details of how those are formed or whatever, but we see those all the time. You can see it in this profile right here, where you can see a high volume node up at 29.97.75, and you can see a low volume node at 29.90.50. Okay, and those mean different things. A high volume node indicates acceptance by the market of a certain price, and a low volume node indicates that there was no interest at that price or low interest at that price. So the question is, I notice sometimes an HVN turns into an LVN and vice versa. Can it be a good indication for a certain dynamic in the market? So here's the thing, market generally tests one area, tests the opposing area, and then if there's not enough force to push below the one area or the other, it generally just sits in the middle. So what we get, and today's an example of this, on the 9th, we skipped through a series of prices from 29.86 and a quarter in EES, and I'm going to emphasize the ES even though I look at other products because that's the most popular product, but we had a 2-point gap. That shows up as a low volume node right here, a low volume node, okay? And so we gap up and we move away. And then yesterday we poked into that area. That area has been a stock zone or a key area for me to watch for a while, and that was yesterday's big target. Notice that today we put a lot of volume in there. And what happens is when the market moves from a high volume node to a low volume node to a high volume node, which is your low today. The low today at 29.77, it went to 75.75, which is about 5 ticks through, was the next important area below. And so it's once we get support in that area, we generally move back to the low volume node and sit there. It's somewhere in between. We tested one accepted price, we tested the other accepted price. Neither side wants to push, so what do? They kind of meet in the middle at the low volume node and just hang there. What is that an indication of? It's an indication that the market is tested and is exhausted temporarily. That's what that is. Okay, that's how I see it. Second question, can you talk about different volume profile shapes and what they suggest for market trends intraday and next day, normal distribution, P-shape, L-shape, double humps, and so on. So I have a lot of material on my website, FuturesTrader71.com, to cover this, but we'll talk about this for a little bit. So there are different profile shapes. Let me clean this chart up for you so we can see a little bit. So these are all profiles, and profiles come in many shapes, kind of like human beings, right? But the shapes have a meaning. Give us an indication of what's going on. For example, this profile here shows high volume node, low volume, high volume, low volume, high volume, low volume, high volume, low volume. This is a trend day profile. This is a profile that's saying, hey, I cannot find consensus. And the market's purpose, the market's greatest and sole purpose really is to find consensus. It's not to screw you out of your money. It's not to run your stops. That's all nonsense. Please don't believe that. That's just victim thinking. No offense to anybody. But the market's here to find equilibrium, okay? It's just like eBay and other markets. It's there to bring as many participants together and trade as much as possible. So in general, the markets want to form equilibrium. Where's my pen here? Okay, so my Epic pen is disappeared. Okay, let me grab it. Okay, here we go. So see if I can draw. There we go. All right, so with this being, so I'm gonna just mark this. So here's a profile that that essentially opened up, tested, made a fat part in the middle, and had an excess. This is balanced. This is a market that day, last Monday, not this past Monday, but a week ago. This profile essentially saying that the market's resting. Where is it resting? It's resting in the area of the lower distribution of the prior day. The next day, we open below, we open down here, and we move right into equilibrium. And what do? We form the highest volume node right on top. So what we have here is 2 days of complete equilibrium, and so the one market is balanced, the next day is trend, and the indication of what shape it is, there are P shapes, there are just normal distributions, there's a B shape. All of these have different meanings, and what I would do is do a search online for market profile, and there are plenty of resources that explain what that indicates. For me, I don't look at the shape by itself. I think that's a mistake, just like looking at a bar by itself. What you want to look at is how that shape was formed. For example, and I'll make this very, very brief because I'm out of time. For example, if a market trades a while in balance, chop, terrible market, and then rips up and then closes, what this profile will look like is something like this. It'll look like a B-shaped profile because a lot of volume occurred. I drew that too high, more like this. And then you might have a little nub in at the top on the close because a lot of volume goes off. See, but this is not a B-shaped. This B-shape means long liquidation. But if the market opened and immediately drove down to an excess price and then went sideways, which also forms a B shape, this tells a completely different story. This is long liquidation. This is a long squeeze. The market is really intent on moving lower and has found equilibrium through the volume profile, through the volume that it traded at the low. It found equilibrium at a lower price. This is a market that was in equilibrium and shot up. So don't be the kind of trader or consumer that just kind of believes whatever's in a book. You need to look at how it was formed and put it back into context. Next. Again, my answers are going to be as brief as I can make them while making sense. I've never heard you mention about the day's intraday trend. Maybe I'm wrong. Can you comment on this, and what is the holy grail to determine the intraday trend? Okay, so trends are fractals. So I can look at a daily chart and establish a trend. I can take a look at a weekly chart and establish a trend. I can look at a 240, 120, 60, 15, or a 300 volume chart, or even a tick chart, okay? And each one of those is going to have, there's a trend built into each one of those chart levels. And what you have to do first as a trader is determine what time frame you're trading in, okay? And without establishing what time frame you're trading in, you're going to hop from being a day trader to holding a swing because it's in a loss to listening to Jack Black and Joe Blow and Samantha B and whomever else. Whatever they say, that's what you're going to apply. You need to define how long what your time frame is, and then just stick with that time frame within that product to determine your trend. Now, how do I determine trend? I do it in a very kind of low-tech way that works for me. I define what the trend is simply by measuring each rotation. So what I have here is a zigzag indicator that tells me, it's set to 7 tick pullbacks. What it does is it says, as long as the market does not have a 7 tick pullback, I'm going to continue measuring the swing as if it's a single swing. So in this situation this morning, we had this open auction out of range. The expectation is the market's likely to spill over. If you listen to my trader bite, that's what I was looking for. Test up, spill over, and then continue lower, right? And what it did is it had this 4.75 point rotation up in the S&P without a single 7 tick pullback. I'm not going to talk about why 7 ticks and all that because that's a lot of detail, and we cover that a lot at convergenttrading.com. And once I see that there's an expansion, so you can see the morning, the rotations were terrible. There was no real follow through. But then I see this strong rotation, I expect a follow-on rotation. So in a very short time frame, this is a 2-tick Renko chart. The bars vary between 1 minute to 5 minutes, depending on the type of activity in the market. Once I see that the market's breaking in a direction, I expect it to retest in that direction once it breaks a threshold called an impulse level. Okay, and the impulse level in the S&P is 5.25 points. We didn't really breach it much today until much later. What's up with my charts? It looks like I lost my data or something. And so we're, the way I look at the rotations, intraday is I monitor if the rotations are expanding or not. So you can see as the market was moving up, as price was moving up, it went from 4.5 to 2.75 up to 4 up to now 2.75 up to 3.5 up. But then you look at the down rotations, and the down rotations are growing: 1.75, 2.25, 3.5, 4.5, and then 8.25, which is a bona fide impulsive move. So now I'm only, when I see that, I'm only trading from the short side because the trend. So this is why I don't use moving averages, because they're likely to lag way behind the action. So I'm going to keep a keen eye on the rotations. The rotations are price-based, not volume-based, and as the rotations build, or as we get expanded rotations, there's a new short-term trend in play. That's the best answer I can give you in the time allotted. Next question: there seems to be a lot of pay-to-play prop firms. You pay a fee to prove you can be profitable for 30 to 60 days. If you pass their test, you earn a funded account with 70 to 80% split in your favor. Was wondering your thoughts on these. Do you know anyone who's had any experience with them, good or bad? I know a lot of people who've had experience with these. This is not prop. This is not prop. And I'm not here to question or offend anyone's business, but prop has no cost by definition. There is no cost to joining, and it's the firm's risk, and there's a huge investment in getting you to be profitable. That's what prop is. You trade at cost in general, and you split whatever profits you make. It's a partnership. When you're in a traditional or a classical prop firm like the one I worked at when I first started trading in equities, or in futures, and the one that I ran for myself. Those are the deals. I'm not going to comment further on this question because I'm likely to offend potential different people out there, and there's no purpose in that. I think that you can find ways to learn to trade, and the problem is most people just blow their account before they have a chance to figure out what they don't know. That's called stage one of competence, and generally people don't know that you really, really, really are unlikely to make money early on, and there's a lot to learn before you can, and so people then ultimately end up having to go to these kinds of arrangements to do it. The next question, let's call it rapid fire. I'd like an explanation of how professional traders scale in and out of positions, if you could do that. So scaling in, okay, there are many ways to scale in. There are many ways to skin a cat. I'm going to tell you as a professional trader that trying to pick a price and be correct like you would have to with a one lot. This is why I've pushed the exchange now, like 7 years ago, I pushed the exchange to release a micro product. Some of you may know that. And they finally released it in May of this year. And the reason being, because I would want my prop traders, I would want anybody who's listening or following to have the opportunity to trade more than one contract. It's really important that you're able to trade more than one contract, because with one contract, you have to be accurate. You have to be dead on. You have to catch the turn or catch some point in the trend with a minimal amount of heat and so on. The alternative is to trade multiple contracts and trade all in, scale out, scale in, scale out. Okay? And the way I do it, I'll just give you a rough example. I can't give you a specific example because I just don't have the time right now. But the way I do it is, let me find a spot. Let's say I start to notice that, let's say there's a delta divergence up here. Now this is a double high on the high of day, so that's a weak high here, which there's a question about that. But let's say there's a delta divergence, and I'm not really this isn't a tier one setup to get short for me because I'm trading against the trend. I'm inside of the prior day's range. The prior lows right here is the green line. I'm above the mid, above VWAP. So I want to explore the short side because I have a setup, but I believe the risk is too high or my stop needs to be far out. So I'll take a short. Let's say I'm trading 3 lots, which is what I'd recommend on a micro contract, trade 3 lots. I would take the short, I would let the market do its thing, get a scale out. Okay, so I'll take the short with 1 contract or 2 contracts preferably, get a scale out, and then when it pulls back and I see that it's failing over again, forming a kind of a hook or a top, I would add to that position and look for whatever targets I have. In this case, it would be the stock zone below, and so on. The prior low is an important area. The IB low is an important area, and so on. And that's how I'm looking to scale in. The thing with scaling in is it happens in 2 arenas. It happens in an area that has confluence. And for example, if these stock zones are within earshot of each other, I've got mid, VWAP, I've got the open, and it's a thick area, but I don't want to miss the trade. I will start building the short position and start loading heavier as it goes towards the upper level, start to load heavier to bring my average up. This is not averaging down. Don't mistake this with averaging down. This is just a structured campaign trade. And as I'm adding, I'm actually taking some off, adding, taking some off. And then that way my average starts to climb up the screen. My scratch point will start to climb up the screen before the market releases. And once it releases and I get a scale out at the prior day's close or whatever, then my average shoots up even further, and so on and so forth. The other spot, you have an area of confluence as one area that campaigning makes sense. The other area that campaigning makes sense is when you have extra wide risk, as I had demonstrated with this example. When you're not wrong, when normally you might use a 3.5 point stop in the S&P, but now because of the structure, you do have an indication for a short, especially something that starts as a scalp short, but you're not wrong for 6 points. So now I really need to reduce my size to compensate for the additional risk, and then I'll just try to trade around that position with a max of half the position or something like that. So let's say I normally trade 40 contracts. I might start out with a 10 lot and build to 20, then take 5 off, add 5 back on, take 5 off, add 5 back on, and so on. And then when it starts to go, now I've got some room, and my risk has been contained with twice the risk amount. Okay. I know this may be a lot of information in a short period of time, but that's what AMAs are for. Please give me a source where I can learn futures trading. I'm regular at your YouTube every day. I can't really do that. I cannot refer to any source out there. I mean, it just depends on your goals, to be honest. A lot of that depends on your goals. I work at Convergent Trading, and the purpose of it is to develop career professional traders as a community and group. We're in phase 1, which is the community building portion, and it's been going slow, but we're building a lot. We're building technology and so on. I cannot recommend anyone that's outside of what I'm doing, because I can't send you somewhere that may misguide you, and then it's on me. It's hard for me to answer the question, and I can only, not to be selfish, but I can only refer you to what I'm doing because I'm in control of that. Next question: with low volatility, is it still worth trading ES, and why? So this question might have come in a few days ago, and the market was in complete chop and just very, very tight. And the market goes, no matter what product you trade, even if it's crude oil or whatever, the market goes from very compressed periods of volatility to expansion, to compression, to expansion. It's the nature of the beast. This is why there isn't one trading plan that'll work on the same market for all conditions, or any market for all conditions. So what you have to do is you have to participate or come in at a minimum as a career professional trader, which is what I'm focused on here at Convergent. what you have to do is you have to come in, if you really want to be a professional, you have to come in with a plan for a balanced market, for an imbalanced market, for a high volatility market, for a low volatility market, and that includes how to size your position and so on. Is the ES the best market for a low volatility condition? For a low volatility condition, it's just a function of how you trade. Low volatility, cool. The rotations are smaller. My stop is going to be lower. My targets are going to be lower, but I can trade more size, right? Until it becomes more volatile, in which case, to maintain equal risk as a percent of my account and my comfort, then I can reduce my size, but now I can go for bigger targets using bigger stops. Is the ES a good market for that? ES bores me sometimes. And ultimately, once, as a trader who's learning, you must master a market. Once you've mastered a market, and therefore, which means that you've mastered yourself, you're a disciplined trader, you're aware of, and can stop yourself from reacting to your emotions and stuff, you can now move into watching 2, 3, 4 markets, and they can be completely different markets. ES, 10 years, Russell, whatever, Euro stocks, FTSE, whatever it is, and just watch for your particular setups across many products. And once you've mastered that, you want to increase your size. You're going to work on increasing your size so you can finally, hopefully, make a good living at trading, and you're not beholden to the fact that one market is dead. Look, money's moving around the globe all the time. It's moving. It cannot stand still. It's like blood. It has to flow. Otherwise, it just congeals and it creates problems. So there's money flow into something. The S&P is dead. Look at gold. Gold is not dead. Gold's been dead before while the equities move. So there's always something, but the S&P provides a balanced, a more consistent, so to speak. Even when it's bad, it's just consistently bad. Next question: what is the lowest account size acceptable risk control for E-mini for the micros? I want to answer this with a simple kind of approach so that you're not beholden to what I say. Here I am going to the CME website, and I'm going to go to, where the heck is it? I'm going to go to risk management and performance, bonds, and margins, and performance margin requirements. And I'm going to go find my asset. It's in the CME. It's an equity index. And I'm going to look for, you guessed it, MES. The MES has a $630 maintenance margin, which if you multiply that by 100, if you multiply that by 1.1, gives you the initial margin. What I suggest for the MES, which is the talk I did at Futures IO about the micros before they were launched, including, and I included a trading plan with that. What I suggested is that you trade the micros with 3 contracts. Trading the micros with 3 contracts gives you about 30% of the risk of 1 ES, okay? The reason you should trade it with 3 contracts is because the 3 contracts afford you the ability to scale in and out and gives you the feel in live markets, as opposed to a useless simulator, gives you a feel for how it would be, what it would be like to trade multiple contracts in the ES, and maybe eventually 30 or 300 contracts. It's all the same. It's all relative to your account size. And so what you do is you take this number. I usually use initial margin, but you can use a maintenance margin, and this is updated, constantly by the exchange once volatility changes. You take that, you multiply it by 3. That is the minimum you need. In my opinion, you reasonably need to be able to trade sustainably any product. So you want to trade this IBV, you know, the Bovespa. You need whatever that is. So for one contract, you want to trade one contract in there, then you need 18 grand. You want to trade 3 contracts, multiply that by 3. Why? Because we never want you to use, it's already a leveraged product. These are leveraged products. We never want you to go and use $500 margins. Now I know at some outlets, unfortunately, you can go and trade the MES for say 50 bucks a contract. It makes no sense to deposit $300 or $500 and go bang away. Be wise, make your money count, make it reasonably, you make the risk reasonable and sustainable. So that's what I would suggest. The minimum account size, probably around $2,000. If not, if you're cutting it close, maybe $1,500. And this is risk capital, so expect to lose this money as part of the process of you learning. Would you advise against trading in different time frames, short, intermediate term, long term, and why? So I've always been transparent, very blunt in my interaction with the public, just like I am with my traders. I'm going to say I'm a short-term trader. I've never been an intermediate-term trader. I've been a long-term investor. And so I'm not qualified to ask this question. I frankly do not have the bandwidth to be able to trade multiple time frames and do an analysis for a swing trade while I'm doing homework for day trading, while I'm looking at investments. I'm not able to do that, and I'm just very, very poorly qualified to answer that question. I don't want to mislead you. The next question, your thoughts on the EMA 7 and 21. So this is an exponential moving average of 7 and 21 on a 1 year, 1 day chart to help give you a movement idea. I don't know. It's not something that I know about. I definitely am not a fan of backtesting moving averages because chances are you're just going to curve fit them and they're not going to be very useful. But if it helps you see, if you plot a 7 and a 21 on a 1 year chart with 1 day bars, that may be able to give you something. I mean, one of the things I have on my composite chart, my daily chart, is the different EMAs that the most popular EMAs that people watch, the 50, the 200, so I can see where that is. I don't trade off of them, but I would advise you to spend more time understanding context and just understanding the story. The market is telling a consistent story. It's a narrative. It's like a novel. It's better to catch, understand that, kind of like reading. You go whitewater rafting, and you're not reacting to the current rock that's coming up. You're looking way downstream as much as you can and positioning your raft in a way that can tackle the obstacle that's coming up. That's reading the narrative ahead of time. Most people don't like to do that. Most people like to turn on their computer and look at one indicator, and lo and behold, they understand exactly what's likely to happen using 1 or 2 indicators. I don't believe in that. I'm not saying it can't be done or people aren't doing it, but I don't believe that's the way to trade. It helps me, understanding context helps me be a little more immune to short-term fluctuations or market misbehavior. Okay. Next question, I'm interested in very large lots, and small lots indicator, which you sometimes show in a pre-market webinar. Okay, so that's this chart here. Let me get rid of this. That's this chart here. This is the volume delta. And the volume delta is a chart that's just simply plotting. So the bars that you see here, they're just simply plotting the aggressive buyer minus the aggressive seller. So this is a volume, not price chart. There's price at the top, but this is volume. So the aggregate is shown in a bar chart. The yellow is any 100 lot or more aggressor buying minus 100 lot or more aggressor selling. So you can see that this morning we opened down here 29.8075 in a pit in the S&P, and as we're climbing, you could see that the large lots, we're just selling them. They're just selling, okay? And you could see a little bit of size coming in and selling it. And I commented about this in the Convergent Trading chat room, stating that, hey, this is a weak rally this morning. I made that comment. I don't know. I made that comment early on. Very large lots selling. The climb is weak. That was at 9:17 Central, so about 45 minutes into the session back here, right here, 9:17. I said, hey, this is moving up with a V large lot selling, and it's a weak climb. So I'm looking for it to roll over, and there's the roll. That's where that chart kind of helps. And sometimes the market diverges. Very large lots are pointing down, but then large lots, which is everything from 10 lots to 99 lots, I want to see what those guys are doing. That's just a different level of participant. They may be running the other way. And then small lots, which is everybody that's less, 9 lots or less, they're just small lots. Sometimes they dominate the market. Sometimes they're taking up everything. So this chart is it's really important to me, and it just simply gives me kind of a not exactly, but a rule of thumb as to which participant is potentially in control and how much impact they're having on price. And I'm using software and a data feed that reports all trades with a tick ID, and then the software reassembles those trades to tell me what the true volume is. Next question. Any advice on overcoming the fear of leaving a recently well-paid job to pursue my ultimate lifelong goal of trading? How do you build up the gumption to take the leap? I've seen this a lot. I've seen this question a lot, and again, everybody's situation is different. The biggest thing that I had to do this. I was an engineer. I was a construction project manager. And I left a high-paying job, about at the time, $127,000, and I was 27 or 28, and I was pretty good for my age. I left it to go and make zero money for a period of time, taking a high-risk leap into trading equities. And so I understand it. Here's the thing that really, really matters is it's your life situation. How expensive is your life? Who is depending on you? How much time do you have in terms of savings to cover those costs? What is your fallback? Are you in a skill set? If you tell me you're an art teacher at a high school and you just want to pursue this, I know that it's difficult for art teachers given the way our country handles, education budget and stuff. It would be difficult for an art teacher to step away for 2 years and find a job in that field and resume at the same salary level and benefits that they once had. But if you tell me, look, I own 3 businesses, I work an hour a day, I've got lots of employees, and I'm thinking of just not doing that and just trading. Oh yeah, well, your situation is great. It's ideal. If you're retired, it's different, and that so on and so forth. So it's hard for me to advise on that, but you really need to make sure, just like with every trade, you need to define and make a plan for your risk. And the risk is relatively high, especially if you go out there on your own and buy a bunch of courses and follow a bunch of people. Your risk is relatively high, in my opinion, that you would lose your money and have to go back. Okay, it doesn't mean everybody does, but a lot of people are misled into thinking that, look at a chart, it's easy, you buy at the bottom and sell at the top. It's not that easy. Okay, it's simple, it's not easy. If there's time, could you share what you would do if you were feeling ground out and beaten, but hell-bent on not quitting? What thing in the past has helped you grind through rough periods in your journey? My trading's currently in shambles and I don't know where to start picking up the pieces. So my biggest advice in that situation is stop. Don't quit, just stop. Okay? You give yourself what you need to gain in that situation. Now, I'm not going to turn this into a therapy session. what you need to do in that situation is gain perspective. So what needs to happen, it's kind of like if you've ever been in a relationship that wasn't working out, as you work on the relationship and work on the relationship and work on the relationship, you actually have a hard time being objective. The best thing to do in many of those situations is to just commit, both parties commit to taking a break. The market's going to commit to taking a break from you by you taking a break from the market, and it allows you to assess things for what they are. And this is what I would suggest. Take probably a minimum of 2 weeks. Hey, it's summer if you're in the northern hemisphere. It's a good time to just quit. And what happens over time is you instead of fighting back, and that's where a lot of the trouble comes from, being ground out and beaten, is fighting back. What happens is you start to really evaluate more objectively. Once that subsides, the ego subsides, you start to evaluate things objectively, and you'll actually, if there is something that you can work on, if there is an edge or something that is positive about trading that you can think of, it'll start to show up and it'll reset you. Hopefully it'll reset you. So take a break, but trading requires grit. Okay. So if the issue is that you're doing what you're supposed to do and it's just not working right now, just slow down, do what you need to do to kind of back off. Market cycles favor different participants at different times, and then come back when things are more favorable. But for now, I would say stop. This is what I would recommend. Just stop for a short period of time with the intent that you're going to objectively look at, with your heart and your mind versus just your mind. You'll objectively look at whether trading's for you. This looks like a big one. Would it be possible for you to let us know the following? What exactly software do you use? Very simple. I show it every morning. For analytics, I use Investor RT, which is just a charting package and it's not cheap. The package I use is about $125 a month, but poor data or data that I cannot use is worthless to me. I always say it's like competing in the Masters in golf with cheap clubs. Good luck with that. My data is IQ Feed, also top-notch data. And it provides tick ID, which allows IRT to be able to reassemble the trades that have been broken up, which is something that the CME has decided to do in 2005 and not show you the demand side of the trade, but the fill side. I use CT Bookmap for execution. So I show that every once in a while. That's this package here. This is an order flow mapping package. It just shows me the intent of the market. Here, you see this order sitting here for a long time. It disappears, and all of a sudden we have a collision up here. It just shows what the intent of the intention of the market participants is. And all of these can be obtained. It would actually help me if you obtain them through the convergenttrading.com website, because we're constantly asking them to improve their software and so on. So if you go to the website, convergenttrading.com, and you go down you go down to recommended, well, hang on, I'm in the wrong place here. Yeah, if you go to recommended tools, it'll give you all of the trial links and all that stuff for everything that we use. Okay. The monthly cost of software services, I think Bookmap, to be able to execute on it, you need the Global Plus, which is $99. IQ Feed, depending on what feeds you have, is probably $100. Even though that sounds like an awful lot of money, the data is professional grade, and I used to pay about $1,600 a month just for the trading package, plus another $850 for CQG integrated client, a portion of a Bloomberg, Trade the News. My monthly cost as a professional trader was $2,800. Now it's approximately $400 a month. Not bad at all. Do you consider agricultural commodities futures?
Sorry, Murad.
Yeah.
There was just one last part of that question. If they can't afford IRQ and everything else, they're asking, do you have a cheaper option? One of the options, a lot of people in the chat room use Sierra charts, which is a lot cheaper.
Yeah,
Um, you don't have to have the exact same setup with Bookmap and IRT and all that that FT has. There are options that you can work with. You just have to decide what works for you, but there are a lot of other options, and
right.
we don't have time to get into them all. I just want to say you don't have to have this to be able to trade.
Right. And by the way, CT Bookmap may not be for you because it, you may not be interested in order flow. You may be just a structured trader. Sierra Chart is a pretty good alternative. It's lower cost for those who want to trade on a lower budget. It's lower cost. It has a pretty decent historical feed that's built in and all that stuff. And I think all in you'll be at about $50 a month. You'll still need some sort of an execution platform, and you don't need CT Bookmap to be able to do that. You can trade right off of whatever your trading platform is. I just prefer to see things the way I'm not recommending that you use what I use. I'm just simply answering the question here to tell you what it is. But you can trade relatively at a relatively low cost. In fact, it's lower cost to trade futures than equities. Do you consider agricultural commodity futures as trading assets? If you're asking if ags, soybean oil, corn, wheat, and so on, if you're asking if these are trading products, they are. They can be speculative hedge, and within a speculative, they can be a swing seasonality type trades. A lot of old guys kind of trade these on seasonalities, but I also know people who scalp cocoa, or cotton or whatever. These it's just another market to me. I mean, heck, if your house had a market maker for its value and had enough participants buying and selling shares of your house so that there's enough volume, I'll trade the shares, the derivative of your house, the paper on your house. It's the same. It's an auction. It's a perception of value. Okay. So yeah, I believe they can be. The problem with ags is that generally, excuse me, generally with ags, I don't know how to turn this off. Um, Generally with ags, you have a physical delivery, so you really need to focus on the contract specs. Meaning, if you bought a contract of corn and then it expires and now you're in delivery, you're going to have to pay up for the full value of that corn contract, and you better be ready to receive 5,000 bushels of corn and hopefully have a big backyard. Most clearing firms won't allow that to happen, but those products can go limit up on floods or droughts, things like that. They just operate very differently than financial products, which is stocks, index futures, things like that, ETFs and things like that. What's the latest new structure and nuggets to Convergent? I was a member almost a year and thinking of joining again. A year ago, where were we a year ago? Well, we added Trade the News. Trade the News is $185 a month. If you bought it from them, Convergent members get it included with the webinars, the market cheat sheets, the statistics reports, the twice a week webinars, and the head trader channel and all these other features, the blog, the journaling page, or the forum, the blog, all that stuff is built in for $69 a month. That's where we are. And thankfully many members joined from day one, and they're still there. And everybody's circumstances are different. We've seen people disappear for a month or two, come back and stay a while and disappear again. It's a month-to-month subscription currently. There are gonna be packages available soon for quarterly, semi-annual, and annual. But we're focused every day. We're focused on the technology, building technology for the next phase. So not much has changed there, but the services at the intro level or the beta level of $69 a month is still still there. It's available to anybody. There's no trial. We don't do trials because you have access to all of our homework data and all that stuff from day one. So we don't do a trial. You'll have to take a minimum of a month. And joining is not, I'm not going to give you trading signals. I don't, I might talk about trades, but the purpose, of Convergence not to show you when to click. It's to show you how to work your way towards becoming a career professional trader, and structuring your own plan and having a good base to start from, or a good place to work out your kinks and to grow with other members, right? So a lot of members in there who help each other out every day, and it's a virtual prop shop where you trade your own account. That's what it is. So next question, what's the definition? And we only have 10 minutes left. What's the definition of opening in or out of value? How does that inform the day's trading plan? Okay, fair enough. So opening, where we open, the pit session makes a difference and informs us about how people see, how the different market participants are seeing the current session. So let's look at not today, but let's look at yesterday. Yesterday we opened right up here at 3,007 and a quarter. We opened right on top of the point of control and right next to the closing price of the prior pit session. So we, Tuesday we did our thing, and then we closed, and then we went through an overnight session, a full overnight session, Tuesday night through Wednesday morning, my time, Chicago time, and we ended up opening right on top of the point of control. What is that saying? It's saying despite all the stuff that happened overnight with the Asian market, the European markets, any news, whatever, the participants in this product did not see a change in value. So we open on top of the point of control, which is the most valuable price and is the key price in a value area, which is here shaded in black. Now these charts look very, very noisy, but they're not. We opened right on top of that area. Come on. Right on top of that area. This is a market that's opening in range. So it's in the prior day's range in value versus a different market back here where we had a fairly balanced day on Wednesday the 10th. We had a fairly balanced day back and forth. We built a balanced profile. This is a very balanced profile. And then the next day we came in on Thursday and we opened right up here. We opened in range out of value. When we open in range out of value, statistically speaking, we tend to test that value area. Essentially, the market has repriced because the day before it closed at 29.9750, and the next day it opened at 3,003.5 and a gap up. But it's still in the prior day's range because 3,003 is inside of 3,750, the high of the prior day. And generally what it does is it retests that value area. And if it retests the value area and does not bounce off the high, it generally tests the point of control. And that's what happened here. Okay. So it's just another kind of rule of thumb or yardstick for how that informs things. We can open out of range, which automatically says we're out of value. We never say out of range, out of value. But it can open in range in value or in range out of value. How to determine poor lows and highs. I would suggest you check out the glossary. I think it's on convergenttrading.com. There are some examples of that. The simple idea behind poor lows and poor highs is that the simple idea behind it, so we call these weak lows, poor low, poor high, see weak low, weak high, weak low, weak high, and I'll give you an example. The basic idea behind this is that when the market has a lot of volume at the high or low, it has not found an excess price yet, okay? So if it's sitting here and it's trading a lot near the lows or the highs. Generally, those, they look like double tops, double bottoms. Most people think that that's resistance. I disagree. From an auction theory perspective and volume profiling perspective, these are not excess. So when a market finds a price that's too expensive and sellers just come in and slam the market down, you get this excess. You get this long wick on a candlestick. You get a market that just very, very quickly runs away. And what we had this morning, this afternoon, actually, was it this afternoon? Yeah, right here, this morning, what we had this morning right here, this 29.90. So up to this point, what we did is we traded quite a bit at that 29.90, and you can see we revisited and then we fell off. That becomes a weak high. It's a double top essentially, and it becomes a weak high, and it's indicating that at some point that area, if it starts to approach at 29.90, that area is likely to be weak and get taken out. We have 4 more minutes. We did about a fifth to a quarter of the questions. Are we just going to continue coiling with low volume till end of July? I'm sure that came in before the break yesterday and today. What is recommended risk percent per trade? How wide is a reasonable stop for a swing or position trade? How do you determine position sizing? So I cannot answer what it would be for swing or position trading, but I would tell you this. It's really, really important for you to define your time frame and figure out how much room is required for a time frame. For example, if I was trading in a very, very short time frame in the S&P, I might be able to get away with a 3.5 point stop. Using a 3 to 3.5 point stop on a swing trade using 15-minute bars or 60-minute bars, you're well within the noise. You need more, probably like 7 or 8 or 10 points, $500 per contract on the ES. So I can't tell you how reasonably wide that stop should be, but determining your position size is governed by several things. One, your account value, and I've done talks about this. The risk, as you increase the risk percent per trade, a stop loss risk percent per trade, the ability to take on more trades gets exponentially reduced. So in other words, I can go, let me do this in this color. I'm going to draw this chart on here. If I have a chart that shows that shows the risk per trade, starting with 1%, 2%, 3%, and this axis is the risk of my account per trade, and then this axis here is 100, 200, 300, 400, and this is the number of trades, okay? If you risk 1%, given your account size, you might end up being able to take 400 trades that are wrong. In other words, you will lose on every trade, let's say. You may be able to take 400 trades at 1%, given your account size. But then as soon as you go to 2, it drops dramatically, and it starts to do this, and it starts to go flat. The more percent, the higher the percent per trade. So the ability for you to take trades, the number of trades you're allotted for 1 to 2%, it just drops very, very dramatically. And you can run this computation very easily on Excel. And what your goal as a trader, honestly, is to take as many trades as you can. Think of your trades as coin flips, because that's essentially what they are. Okay, coin flips, hopefully with a positive statistical edge. Every trade stands on its own. The coin isn't going to drop differently just because you got heads last time or tails last time. It is completely discrete. Your current coin flip is completely discrete or unique to the current coin toss, versus the prior coin toss. And your goal is to take as many coin tosses as you can. That's how you move towards your edge and actually become a career trader, is to get, it's not 10,000 hours of homework. No, it's not. It is more like 10,000 trades or something of the sort. You want to trade as much as possible over time. Where am I? You want to trade as much as possible over time, and so you want to keep that risk low. In my opinion, 1% per trade of risk stop is one factor. The other factor is the volatility of the product is very, very important. The other factor is your psychological makeup. You might accept that, hey, I'm going to take 20 point stop, and then it just immediately drops 10 points, goes to 18 points, comes back to 12 points, goes to 15 points, and you're just not sleeping for days and days and are just driving your family, yourself, bananas. So you have to kind of factor in your risk appetite. I can't tell you what that is for a swing or position trade because I'm not a swing or position trader. I would be talking out of turn. Is there an update on the course? No, there's not. May you please give examples of your 5 to 7 hypos on your trader bites? You normally only give 2 to 3. So it's simple. You end up with 5 every day because there are 5 positions the market may open in. It may open in, and it's opening in range in value, in range out of value, above range, below range, and I'm missing one here. In range in value, above, in range, oh yeah, in range above value, in range below value, out of range above value, out of above range and below range. Okay, so that's 5 different things that may happen, and that's strictly based on where it opens versus where yesterday is, because the narrative is continuous from cash session to cash session, or pit session to pit session, really. And so where it opens versus yesterday's pit session, why the pit session? It's because it has the underlying stocks. It has the stocks underlying it, and that's the true valuation of that product. If the stocks are closed like they are at night, it's just trading in sympathy with the rest of the globe, versus during the day where the stocks are moving along and there's an actual product underneath it. So you build hypos on that, and then given the scenario is given the context of what's happened, or the narrative or the story, then you can build what you might expect as your key trades based on where you think it's going to open. So we have a pretty good idea of where it's likely to open by about 9 o'clock Eastern. When I do my trader bite every morning that anybody can watch free here on my YouTube channel, by that time, I have a pretty good idea of where the market's likely to open. And given the overnight session and what it's done, given the prior session and what it's done, I have a pretty decent, I can make a pretty decent estimate as to how things are likely to play out. And those become the scenarios. Okay, so I can't continue to answer here. We're out of time. And I just want to respect everybody's time. I want to remind everyone that we do these every once in a while. Make sure you register even if you're not attending, so we can send you the recording. Anyone who's interested in Convergent trading, you can find us at convergenttrading.com. Our motto is "We grow as one." It is the first virtual online prop community out there. I'll leave you with that. Thanks for joining today. Hopefully you actually gained something. I hope you had an aha moment. This is why we do this. And I want to thank Yoda for helping me out with the moderating. Take care, everyone.
Before you go, if you like what you saw or heard, we do these every Tuesday at noon CT. So you can come in and ask questions if you didn't have something and don't want to wait to the next public AMA.
That's right. That's why I eliminated all the members' questions from the list, because they can ask every Tuesday. And of course, they can always ask in the chat room any day of the week. So we'll leave you with that. Thanks, Yoda, and take care, everyone.